Well, hello everyone. Welcome to After the Close. My name is Barbara Armstrong. I'm a coach with Schwab and delighted that you are joining us for this class today. Kevin Horner is off. He is roaming the hills with his buddies. They are off doing fun stuff this week on a well-deserved vacation. And so I have the pleasure of being here filling in for him. And we have Mr. Ben Watson coming to us from the airport in Little Rock, Arkansas, of all places. And so if you've got any questions, Ben is sitting there with a smile on his face, surrounded by fellow travelers and ready to help out if need be. If you are not following a lot of us on X, you are missing out, my friends. Barb Armstrong CS, Ben Watson CS, and Kevin Horner CS. Be there, be square. Now, I know that some might argue that I'm easily entertained, but I think we have a really awesome class lined up for you today. We are going to talk about buy right covered calls. And, you know, there are some people who might, be confused by this strategy, and I know that I was when I first heard of it. I thought it was the dumbest thing I'd ever heard of. And, when it was explained to me, it's like, oh, you have my interest. Like, please tell me more. But the idea behind today's class, and this idea with After the Close, is some people, have things like JOBs where they have to work during the day and they can't be looking at the markets all day long. So their opportunity is after the kids are in bed at 8 or 9 o'clock at night. And so they're looking for things that they can, do at night, that they can maybe check briefly in the morning and then not look at them again all day and, be good to go. And sometimes we look at growth strategies or longer term investment strategies. Today, we're going to look at a shorter term income generating strategy, and that is called the way we are choosing to use it, it's a buy right covered call. Okay. So, and know that, whatever strategies we talk about, we're going to look at several different stocks today. But, know that these are all for general information purposes only. None of them are to be construed as individual recommendations of any particular stock or investment strategy. When we talk about options, and this has a stock and an option component to it, know that options carry a high level of risk and aren't suitable for all investors. We're going to talk about the risks involved with this strategy. And know that all investing involves risk, including the loss of principal. We're going to talk about that too, because we're buying stock and we're going to look at how we can manage the damage if the trade goes against us. Okay, we will be using the Paper Money software application on the Thinkorswim desktop platform. Say that 3 times fast. But this is a brilliant place to learn, to hone your skills, to practice, to make sure you understand how to place trades, not only on the platform, but how to make sure you understand what you're doing when you're placing a trade. Okay. And so for those of you who were in the earlier classes, welcome back. And for those of you who are joining us for the first time today, welcome to each and every one of you. And thank you to those who are being so participatory in the chat, to Norval and Jim and Ricebird and Andy and Willie and Elizabeth and Greg and Marisha and Jay and the rest of the gang. Thank you all for being here. I appreciate it. Okay. So one quick announcement, and this is at a new time slot. It's still the same instructor. Typically, Kevin is here when he is available. But it's now on Tuesdays instead of Thursdays. So, if you're not sure of the schedule, you can always go to schwab.com/coaching and look at the webcast, and you'll see the revised, the new as of the beginning of October schedule. If you have never been to an in-person event, Ben Watson has been, I think, at every single one this year, and we're doing like 24 of them. And the last 3 are Anaheim, the weekend before Thanksgiving. It's a market drive where we go from what's happening globally in the markets down to looking at individual stocks. We'll have the coffee on in the morning. We'll feed you breakfast, lunch, and have a great reception with libations at the end of the day. So we'll feed your body and your mind. Houston, we've got a 2-day event, intro to technical analysis, intro to options, mid-December. And then Miami, the weekend before Christmas, a 2-day advanced options event, December 19th and 20th. And Ben and I will be there, with the hats and banners going, for all three of these. So I hope you'll join us. They're free to attend, but they do tend to fill up quickly. And I know that there have been people that have been shut out because registration was closed. So if you're thinking of going, I'd say throw your hat in the ring sooner rather than later. Okay, let's get out to the platform and let's start with a description of what this strategy is about. And we're going to start with, let's start with Take Two. Take Two Interactive. So this is a stock where, when we look at it from a technical perspective, had a bit of a double bottom, right? Do you guys see that on the charts? So we had this double bottom. And, we had this range here of, call it 220 to 243, this range of about 23 points. And so someone might say, well, I'm expecting it then, a technician might say, I'm expecting it when it breaks out to go up another 23 points. And actually from 243 to 263 is 20. So if we're saying, we're expecting it to go up to about 266. It's been kind of coming along, right? Because it broke out. Here was our resistance level. We just talked about this in getting started with technical analysis. And then that resistance became a new support level. And now it looks like this 30-day moving average, it may be bouncing off of that this 30-day may now be kind of picking up the slack and acting as a potential support level. And so if our target were, let's say, just, for giggles, 266, could we do this idea of buying 100 shares of stock, which would cost us about $25,700, and then selling a covered call maybe around this 265 level? And you might say, when I first heard about this, I thought, are you nuts? It's going to get run over and you'll be called away. Why would anybody in the right mind want to do that? Because if this keeps going up and it goes through our strike, we could be called away at any time. It doesn't matter how far we are in the money. But, if we were called away and if you said, well, let's run the numbers and see if the numbers are interesting enough that we could maybe make, 2 or 3 or 4% or maybe even more in a short period of time. And so if you were looking for an income generating strategy, let's say you wanted to take the family to Disney for Thanksgiving, have no idea who might want to do that, unless you're Ben Watson. or maybe take your family to Paris for Christmas or to Cabo, or I'm just throwing ideas out there. But let's say you have a chunk of money that is sitting unemployed. And so in this example account, we have $1 million and we have 474,000 of it sitting in cash, making no money for us at the moment. Let's just say that that's what's happening. And so could we take, 26,000 of it, come to our trade tab, come out to maybe November? So, it would be money in time for Christmas if it worked out, or in time for Thanksgiving potentially. And it's sitting at 257. We said we were thinking it might go up to 260 or 270. If we sold the 260, they'd pay us $1,300 for that. $1,330 to $1,390. There are 1,400 contracts. Take Two traded almost 1 million shares today, and it's saying there's a 94.67%. This is probability of touching, and the second number is probability of in the money. You have a 46% chance of it being in the money. And you might say, well, I would want it to go up more than that. So I'd want to sell the 270. You can sell whichever one you want. But if you want the higher probability of being called out, you might look at this 260. And unfortunately, we don't have a 265 option. These are $10 wide options where they are now. So if we look at this and we said, now on the Thinkorswim platform, I'm calling it a buy right covered call. But this is on the platform, they call it buying covered stock, because we're buying 100 shares of stock and then we're covering that with a covered call. So we paid $244.12. What's the most we can make? Well, the most we can make is $2.60 a share, right? Right. Just say yes. And this was, let's call it 244. So if I take 260 and we subtract 244, what have we got? $16 a share. And if you don't want to do the math, we can just come over here and say, okay, the most we can make is $1,588. But let's say you were hoping to make $5,000 a month with this, money that you have that is unemployed, which would be, how much did we say we had? About $500,000, 474,000. So, a 1% return in a month would be 404,000. And it's just, you're looking to generate a little extra cash. You don't want to take the principal out, but if you could generate a little extra cash, that would be nice. And so this position would cost us 24,000. Now, what if it goes wrong? Because, we start looking at this and going, that looks like yummy, $1,500. Like, that's easy. And then if you look at that as a percentage and you say, well, if I could make $1,588 or $15.88 a share, 15.88 divided by 244, that's a 6.5% return. And so if we look at this and we say, okay, but if it goes wrong, where would I want to put a stop? At what point do I want to get out? Now, with Take Two, you might say, well, I think this 30-day moving average is going to act as support. If you want to give it more latitude because you're okay with owning the stock, maybe you say, well, this was a pretty strong resistance level. Looks like it's held up beautifully as support. I'm going to put my stop below this 243 level. So if I come here and I say, okay, 243 times 0.98, that would give us a number 2% below. Okay, obviously I messed that up. 243 times, I know what I did, 0.98. So 238 is where my stop is going to be, 238.14. So when I come in here, if I'm paying 244 and the stop is at 238, we're risking about $6 a share. Now, I met someone in Chicago one time and he said, I really like this buy right covered call strategy, but because I've sold the call, I have no way of protecting myself to the downside. And I said, yes, you do. What you have to do is come to first trigger sequence, right click, create an opposite order, and then you're going to say, okay, I'm going to make this good till canceled. I don't know how much I'm going to have to pay to buy that call back. I'm going to have to pay something, but it's going to be less than what I sold it for, I would hazard to guess. But in any event, whatever that price is, if it goes below, and what was our number? Just let me move this. Does anybody remember that number? It was 238. Let's call it 238.14. $238.14. Confirm and send. So we're saying we want to buy 100 shares of Take Two Interactive, and we're selling the call at 260. And right now it's trading at 257.70. And so a lot of the money we'd be making is in the call that we are selling. And we're going to put this in our buy right covered call bucket. And what this is saying is, hey, there's no guarantee with your stop loss order that you're going to get out at the price you're recommending. Our price to get in is $24,412. Now we're putting this in after the market closes. And so tomorrow morning, you may want to check and just make sure that this 244.12 is going to get us in, at the price we are saying we want to get in at. Because if it comes in at if it opens at 244.30, it won't fill. Because we're saying we don't want to pay any more than 244.12. Yeah. Okay. Okay, so there's the first one. Let's go now and look at UNH. And with this one, this one was bouncing off the 30-day moving average instead of this support level. So we put our exit a little further away, didn't we? Stop ought to be lesser than. Did I make it more than? Working orders. Let's go look at that, because if I did, I made a mistake. This is less than or equal to 238.14. Yeah. So we got that right. But thanks for having me check. And that's how we see it. Is we come to the order and there's this sprocket that says it's awaiting a trigger. There's a conditional order. You click on it and it will show you that conditional order. Okay. So healthcare is a sector that has been, for some stocks, coming around the corner, and UNH has been one of them. And this is a stock that's been pretty downtrodden. It's still down 29% year to date. But again, we're seeing this similar type of pattern. Are we not? I'm just bringing up my drawing tool. Oops. I always forget to erase. But here we are, inverted head and shoulders. And then it broke out. So here was our breakout, came back to retest. And now once again, this 30-day moving average seems to have kind of swept underneath and caught it. And so, if we look at this, and let's just zone in. So if we look at this, like here yesterday, we had this big down day in the market in general on Friday. I think the NASDAQ was down 3%. And then yesterday we had this bullish harami. And today, is continuing to the upside. So if we said, I wouldn't mind, it's not that, and guys, we aren't looking at a lot of fundamentals here. We are buying the stock, but this is not a marriage. This is a short-term dating strategy. Okay, and we're saying, hey, we're going to hang out for a bit, see how it goes. If it goes well, maybe we'll do it again. If not, it's been nice meeting you and we'll see you later. Okay, that's what this strategy is about. So if we look at this and we say, okay, it's currently trading at 359. If we come to the trade tab and we look at November and we say, if we went out to 370, now this recent high was what? So if I draw my 370, it was 4 days ago, it was higher than that. So could we do this buy right at 370? And I'm just going to right click on this. We're going to edit it. And if you want to put it on your chart, this is how I do it. I say, okay, here's 370. We're going to do a buy right covered call for November. I think it's the 21st. So we will either buy this back and close it out before the 21st, or, we could let it expire worthless. Yeah. So, but if we come and we look at this, this is an expensive stock. This is an expensive option. And yet there are over 2,700 contracts, 412 contracts exchanged hands today. We have a 40% probability of it being in the money, and 83% chance of it coming up and kissing it. So what happens if we come to November 21st and it's trading at 368? Well, the odds are it would expire worthless. And we would get to keep this $1,560 to $1,600, and then we could sell another one. We'd still own the stock. If it's trading at 375, we would receive the 370. And what are we paying to get in? Well, let's figure it out. Let's do our math. Math can, help us make that decision, right? So if we're in at 343, let's call it 344, 54, 64, 70. So it's a 2,600 is the most we can make. So 2,605 on an investment of 34,395. So if we just took, and I'm just going to use my little phone calculator here. If we took our 2,605 that we can potentially make, that's our max gain, and we divided it by 34,395, what would that be as a percentage? That would be 7.5%. And so if you think, well, that's terrible, well, then don't place the trade. But if you're saying, I think that's not a bad return, potentially, this is potentially, we could end up losing on this for a trade we will be in for no more than, is it 38 days? So if you're saying, okay, that meets my criteria of acceptability, hello. And then you might say, well, I could use this 30-day moving average. I could use this 328, or I could say, well, hey, if we come in a little tighter, this was a ceiling, and now it appeared to become a floor. So I could take that 354, or what was the low on that day? 353, 353, 352.50. So if I take that 352.50 and multiply that by 0.98, or you might say, I want to give it 352.50. I'd like to give it 3% worth of wiggle room. You can do this, you want to do it consistently, but that number doesn't have to be 2%. It doesn't have to be, 3%. So 341.92 would be our stop. 341.92. Okay. So 341.92, and if we come to our trade tab, what are we paying to get in? Well, 343.95. So our level of risk is not that high, and our upside is, $2,600. So that seems like a bit of all right. Now, there's no guarantee if UNH were to gap down, we could end up out at a lot less. But this call that we're being paid so handsomely for is helping reduce this price and reduce our overall risk, to the downside. So we're going to say, okay, UNH at or below 341.92. 341.92. And then you may want to come down here. Do you see at the bottom it says less than or equal to? Because these signs can be confusing. And this is also why you want to read this sometimes out loud. I want to buy a covered UNH because I'm bullish, right? But it's a short-term dating strategy. And then I want to sell if the mark goes at or below 341.92. Yep, it's currently trading at 359.93. We're going to put this in the buy rate bucket. Okay, so as you know, I have filled in for Kevin fairly frequently in the last month, and I've done 2 previous classes. Oops, sorry guys. One 3 weeks ago, short-term income generating strategies where we were using buy rights. So this is a bit of a theme I've been on. And then we did some investment in some income generating strategies, when I filled in for him on the 11th. The reason that I am bringing this up, and then if we come back here out of after the close, and if we come down to the trade management mini sessions, You might say, like, why on earth is she doing that? Well, I'm doing that because one of the things that I created was a bunch of, and they're all in blue, example trading plans. So last week, I think Kevin talked about some spread trades. So if you wanted an example trading plan for a short call vertical or a short put vertical or a long call or a long put vertical, I've got those in here. But there's also one for this buy right covered call strategy and this idea of we're buying it in the middle of the road when something is bouncing off the support with the goal of being called out. Okay. So how did the trades work out? And we're going to place another trade, I think, but how did those trades work out? Because I think it's important once we place the trade and we're in the darn thing to understand what we're doing once we're in it. And so if we look at Apple, we bought 100 shares of Apple and then we sold this 250 call. The stock is currently trading at 247 and the value of this option is now has fallen to 168. It expires in 3 days. So we bought the stock for 238. It's now up almost $1,000. So we're up $842 on the stock. And we're up 77.50. And this, I like a class to be somewhat interactive. So we're going to do a little poll. So I want you to vote. So let's come and look at the charts. So if we look at Apple, oh, this is interesting because I drew a channel here where, you know, for getting started with technical analysis. But the net of it is that whether I drew a channel or we're looking at, you know, breaking above a previous support level, maybe here, it closed today at what price? It closed at 247.77. How much does this stock move in an average day? Well, if we add ATR, which is the amount, the range that this stock moves from the high of the day to the low of the day in an average day, we can see that as of today, over the last 14 days, this stock moves about almost $5, $4.83 in a day. So, and it's come to a support level, and then we have this big down day. So it was trading, you know, above our strike, right? Our strike is 250. Like last week, it was trading up around 259. And you may say, well, if one of the things that's different between paper money and a live account is that you'll never be called out early in paper money. Now, you may think, and I've had people say, well, it's trading in the money. How come I haven't been called out yet? Like I sold the 250 call and it's been trading at 255 for 2 weeks or above. Well, you may never be called out. Okay. But this option expires Friday. This might be a bounce off of support. Do we want to just let it ride and be called out? Or if we're thinking it may bounce, might it come back up to this 260-ish level? And could we sell another call instead of at 250 around 260 or 265 and make a little more? And so the question to you is, you know, do we buy back the call? Because if we want to wait for the bounce, then we would buy back the call for a small profit and then look to sell another call maybe next week or once it comes up. Now, it might not come up. But so do we buy back the call? And this is on Apple. And we'll go with whatever the group thinks. So you guys have a voice. So there's your poll. And feel free to get in there and vote. So do we buy back the call with the intention of selling another call when it gets up closer to resistance? Okay. Now let's look at another one that's in here. So if we look at RTX, I think we put this one on this at the same time. So this one also expires. We bought 100 shares of stock. We sold the 165 call for $2.49. It's now worth 6 cents. It's now, sorry, 15 cents, and it expires in 3 days. And we bought this at 160, the 165 call. The stock's up a little bit, but not close to that 165. So let's look at this one. So here, we bought it, I think, on this day on the 19th, or we might have bought it on the 26th. But it came up, it was in the money, and then it's come down. And here, you know, this 30-day moving average has been acting as a bit of a support level, right? Came down just below and then rallied, came down again, closed 1 day below. And then yesterday's candle, we saw a lot of these, a bullish harami, where this candle is totally inside this candle's day. And then today, this is really a bullish engulfing at a potential support level. And so if we think this might go back up, it might not go up in time. You know, how much does the stock move from top to bottom in an average day over the last 14 days? You know, it moves about $3.10 according to this average 2 range over here. But if we can buy it back, this one, we've got most of our money, right? It's only, you know, like 15 cents on $2.49. That's got to be 95%. 15 divided by 249. That's 94% of what we could have made. And so, and the stock's gone up a little bit. But if we are thinking it might go up again, the idea isn't necessarily to keep RTX forever. But if we say, well, we could cash it out and take our $414, or we could take this 234 and look to sell another call in a few days when it's closer. Because the closer it is to the strike we're selling, the more money we may be paid for it, depending on volatility and everything as well. So we're going to right click on this, create a closing order to just buy this back, buy the call back, with the intention of, if I were to fill in for this class again next week, of maybe selling another one. Okay? Confirm and send. So that's teed up for tomorrow, and we'll want to make sure that that one fills. Okay, now here's one for Zscaler, and this is another interesting one because, you know, we bought 100 shares at 286. We sold the 310 call, so it was way far away. You know, but this stock must have a lot of volatility, is my guess, for us to get 415 for it. We've got about 50% of our max gain. This too expires in 3 days. The stock is trading for 301. We have $1,721 in unrealized gain. At the start of the day, we had 2,300, but the market took us away 554 because the stock dropped today. So let's come and look at the chart. So with this example, you know, might we just say, hey, this gap down today, it hasn't come down to a support level yet. It could continue to fall. So maybe we just exit the position altogether. And if it comes down here and bounces, could we buy it again and sell another covered call? Well, we could. And so I'm just trying to show you some different ways of looking at it. So on the one, we said, hey, we're just going to buy back the call and look to selling it again because it appears to be bouncing. On this one, we might say, hey, $1,700, that's not nothing towards our Disney fund or our Cabo fund or our Paris fund. Like, we'd like to turn this unrealized gain into a realized gain. And so what we're going to do is come here. We have our stop on ZS, and we're just going to cancel that whole order. Okay. So now when we come and we look at this, we can see that Zscaler has no chiclet beside it. And we're just going to highlight the whole position and say, hey, we just want to buy this whole thing back and we're happy with the money that we're making. Okay? Okay. Now the vote was 81% on Apple. Let me just bring this up. We're going to end it. So, do we buy back the call? 81% of you voted yes. And there were 36 of you that voted. So, that's a pretty reasonable crew. So, what do we have to do? We have a stop or an exit on this. So, we are going to come to Apple. And here's our exit on this one. We have a lot of positions on Apple here. 100 to close. Triggered by. So this is our covered position. So this is the one we're going to exit. We're going to cancel this one. Now, when we come here, we see that that chiclet with the order is gone. And we're just going to say, okay, we want to buy this back. And time decay is going to be chipping away at the value of this. So now if it rises tomorrow, its value could go up because you've got time decay working for you. If it rises in price, then we have the price kind of working against us, right? So we're saying we just want to buy back the call. All right. So guys, it's hard to believe, time is ticking away on us, but we have reviewed and made 3 different decisions on how we want to manage these. And then FANG is the last one. So FANG, we got paid $5.30 for this. It's now worth 22 cents. But and we had 2 contracts. So we've made $1,000 on the calls, but we're down 1,500 on the stock. So let's look at FANG. That was our 4th one. And so this is one where we said, hey, we had a little different tact on this. We said, hey, this is coming up and bumping its head. Maybe we could sell this call here, make some money, buy it back when it pulls back, and then if it bounces and comes up again, sell another one. So we bought it with the understanding that this might happen. And what do you know? It has happened. And so we're going to come out to the monitor tab. We're going to come out to FANG. We're going to say, okay, we anticipated this might happen, and this was how we wanted to react to it. We're going to, and then tomorrow we'll come in and we'll put in a new exit. Once we have sold that covered call, because we don't want to leave ourselves without any downside protection. But we're just going to not sell the whole position. We just want to buy back those 2 calls. Saying, well, we want you to pay 30 cents. You might say, well, let's see if I can buy them back for a quarter. And then in the morning when the market opens, you just want to make sure. And then you can close your laptop and go on with your day. Yeah, Paul is saying I like Cabos. So it is a strategy, and you might say, okay, like this particular position, we have in total here, when we look at it, almost 100,000 invested. That's the net liquidating value. The stocks might be worth, a little bit more, and we currently have an unrealized gain of $2,500 on that $98,000 invested. But what the market giveth, the market can taketh away. So we're looking to just take that little bit of profit, maybe move it over into our profit bucket and then do it again. Wash, rinse, repeat. Now, it may not be with the same stocks, but we've looked at different ways of managing them once we're in them, right? Right. So if you have any questions, if you're watching this again in the archives, feel free to fire any questions you might like at me. I do look at those on a daily basis, and I will get back to you pretty quickly. So I hope you found this helpful and informative. We put in 2 new orders, one for Adobe and one for Apple. Or sorry, let me, those filled today in my getting started with technical analysis class. Let me sort these working orders by time placed. So we put in orders to close to manage FANG, Apple, and Zscaler. And then we looked at 2 new positions on UNH and Take-Two Interactive. So guys, that's a wrap for today. Please hit the like button. It helps move this up in the algorithm so more people can find this content. If you haven't subscribed to the channel, you'll want to do that for sure. And yeah, make sure you follow Ben and I in the Land of X, Barb Armstrong CS, Ben Watson CS. Come out and see us at a live event. And somebody said, Ben, you've been at every live event I've ever attended. That doesn't surprise me a bit. He doesn't miss many. I'm getting to attend and be part of more as we go. And I love having that opportunity to connect with each and every one of you. And it's great to see the lights go on sometimes. Like if you can pick up one great idea from a webcast, from one of these live events, it can change a lot. It can be profoundly impactful. So guys, have an awesome rest of your day. This is the end of our live webcast day for today, but we'll be starting again in the morning with Trader Talks at the market open, 9:30 Eastern. So be there, be square. Get out and hug someone you love, everybody. Have a great night.